Ladies and gentlemen, good day and welcome to Carborundum Universal Limited Q4 FY25 earnings conference call hosted by DAM Capital. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bhumika Nair from DAM Capital. Thank you and over to you, ma'am.
The management today, presented by Mr. Sridharan Rangarajan, Managing Director, Mr. Sushil Bendale, CFO, and Mr. G. Chandramouli.
Yes, sir, you can go ahead.
All right, okay. Good morning to all of you. Yeah, go ahead.
Good morning. I'm Chandramouli. Before getting into the call, I will read out the disclaimer. Good morning. During this call, we make certain statements which reflect our outlook for the future or which could be construed as forward-looking statements. These statements are based on management current expectation and are associated with uncertainties and risks are more fully detailed in our annual report, which may cause the actual result to differ. Hence, these statements must be reviewed in conjunction with the risks that the company faces. Thank you.
Good morning to all of you. I hope I'm audible, and a very warm welcome to our fourth quarter and full year earnings call 2024 and 25. In today's call, I would try to cover as much as possible to give you all the facts that the company has gone through in the last couple of quarters so that you get a better picture of the performance and relate to that appropriately. I'll start with consolidated sales. Consolidated sales on a full year basis was 4,834 crores with a growth of 4.4% compared to the last year. This growth was driven by ceramics 7.7%, abrasives 3.3%, and electrominerals 1.9%. At standalone, the sales grew at about 7.3%, and the challenge at the consolidated level is largely coming on account of the softer VAW growth in Q4, which I will describe more in detail. However, subsidiaries such as Rhodius, Foskor are all grown well. Rhodius has grown 6%, Foskor has grown by 15%. So we have Q4 challenge arising out of the VAW post-sanctions. I will cover that in detail. Consolidated PAT was 168 crores, lower compared to the last year, which is 461 crore was the last year FY24 number, and 293 crores is this year's number. So there's a shortfall of 168 crores. And I will broadly explain what is the reason for this 168 crores upfront. At VAW, we made a provision of 91 crores. This is a post-tax amount that I am talking since I am covering the post-tax in Q3, and we have already described the reason for that. In Q4, since the sales volume of VAW came down post-sanction, the profit also came down by about 24 crores. Besides this, in AWUKO, we reversed the deferred tax credit to the extent of 32 crores, plus we have not taken deferred tax credit for the losses in FY25, which is roughly about 18 crores. So these are the broad reason for the shortfall. So consolidated PAT was lower on account of these exceptional items. There are two broad items. One is VAW, which is relating to sanction, and post-sanction, the lower volume. So all of that is relating to sanction related. And the second one is the deferred tax credit reversal in We feel these are reversible once the situation improves. So that's how I read this situation. PBIT on a full year basis was about 541 crores compared to 621 crores in the last year. This was lower by 13.4% over FY24. PBIT from ceramic was marginally higher. Our PBIT from electrominerals and abrasives were significantly lower. The drop of 84 crores was mainly due to VAS to the extent of 36 crores and AWUKO to the extent of 31 crores. So overall PBIT margin decreased from 13.5% to 11.2%. On standalone basis, full year, the sales was at 2,784 crores with a growth of 7.3% compared to the last year. This growth was contributed by electrominerals at 10%, ceramics at 6.5%, abrasives at 3.9%. Standalone profit after tax on full year basis was 322 crores as against 350 crores in the last year. This is due to higher unallocable expenses, the details of which will be covered by Sushil later in the section. I will cover the segmental performance. Abrasives to start with. On a consolidated basis, abrasive sales in FY25 was 2,159 crores. This is a 3.3% growth compared to last year. Standalone contributed 3.9%, Rhodius 6.4%, AWUKO 11%, showed good growth compared to FY24, whereas the Sterling had a small degrowth, largely relating to their agro business. Standalone abrasives sales on a full year basis was 1,195 crores with a growth of 3.9% compared to the last year. The growth was majorly driven by volume, both in industrial and retail. Precision was a bit softer. That's how the overall growth was about 3.9%. Rhodius on a full year basis achieved net sales of 67 million compared to 63 million euro during FY24. This represents a 5.5% growth over the last year. This was mainly due to volume growth. On a full year basis, Rhodius incurred a loss after tax of 0.2 million against the loss of 1.5 million last year. So the losses have come down significantly. If we exclude the PPA write-off of 2.8 million euro, they delivered a profit after tax of 1.8 million. So this is what we were also earlier communicating with you. Moving to AWUKO, AWUKO achieved a sales of 10 million on a full year basis. This is a growth of about 10% compared to the last year. The losses before tax on a full year basis was 6.6 million euro compared to 3.3 million during FY24. The difference is on account of two things. One, there was a gain in FY24 which is not recurring, plus an inventory provisioning in FY25. So put together is the difference that we are seeing. Besides this, we have also stopped taking deferred tax credit. This resulted in a reversal of 3.5 million of deferred tax asset. This is deferred tax asset until FY24. Plus the 3 quarters, whatever we took, that also we reversed in Q4. Besides not recognizing for this year, which is roughly about 2 million euro. So in total, on a full year basis, the loss after tax was 10.2 million against 2.3 million. So the swing is majorly driven by the reversal of the deferred tax asset. The reason why we took this decision was we wanted to see delivery of profit before we continue taking this deferred tax asset credit. and hence we reverse this asset so far what we have taken. Now I'll cover the PBIT performance in the business segment. Consolidated abrasive PBIT on a full year basis was lower by 17% at 151 crores as compared to the last year. The major drop is coming from AWUKO due to the inventory provisioning and one-time gain that I just talked about. Standalone PBIT was lower by 1.3%, mainly on account of product mix. On electrominerals, consolidated sales in FY25 was 1,574 crores, showing a growth of 1.9% compared to the last year. Standalone business grew by 10%, Foskor grew by 14.8%. All of them showed a good growth. The performance of VAW ratio was impacted in Q4, the specifics of which will be covered in the subsequent section little later. Standalone electromineral sales on a full year basis was at 815 crores with a growth of 10% compared to the last year. This was on account of the increase in volume and a price realization. Price realization was much higher compared to the volume growth. The other feature of this growth is that we have a higher exports compared to the last year. There is a significant growth in export. VAW until 9 months ending December 2024, the company's operations were slightly better compared to the last year. They delivered a growth of 2.2% in the first 9 months. As communicated earlier, as per the press release of United States, VAW was put on sanction on 10th of January, included in the SDN list of OFAC. As a result of this designation, was business in Q4 got impacted. Silicon carbide volume came down by 30%. Abrasives and refractories were almost flat. In Q4, VAW made a sale of 1.8 billion in Q3 FY25 and ruble 2.31 billion in Q4 FY24. They made a profit after tax of 11 crores in Q4 25 compared to 35 crores in Q4 24 and 38 crores in Q3 25. These are all excluding exceptional items. On a full year basis, VAW made a sale of 9.4 billion against ruble 9.7 billion in FY24 and delivered a profit after tax of 119 crores, excluding exceptional items. This means that whatever the provision that we made is not considered part of the 119 crores against 149 crores in FY24. So roughly 30 crores of profit is lower compared to the last year. On a full year basis in Foskor Zirconia, witnessed a sales growth of 9% compared to the last year. The growth was majorly driven by the volume. On a full year basis, Foskor incurred a loss after tax of roughly about 12 crores as compared to 7 crores last year. Now I will cover the PBIT of the segment. Consolidated electrominerals PBIT on a full year basis was lower by 25% at 177 crores as compared to the last year. The major drop is coming from VAW. Standalone PBIT was lower by 11% on account of higher input costs. Now I'll cover the ceramic section. Consolidated ceramic sales on a full year basis was 1,160 crores. This represents a growth of 7.7%. The growth is mainly driven by CUMI India. And Indian ceramic business, standalone ceramic business on the full year basis were at 939 crores. This is higher by about 6.5% compared to last year. In industrial ceramic business, metallized engineered ceramics grew substantially well, almost double-digit growth. while the ware ceramics remained flat. Due to the absence of major orders in ware ceramics, this remained flat. The fire and mono-refractory business grew well, again high teens growth. Corrosion-resistant business, which is highly project-dependent business, had a degrowth, and this resulted in a net growth of 6.5%. Now I'll cover the PBIT performance of the business segment. Consolidated ceramic PBIT for the full year basis was almost flat at 286 crores. Standalone PBIT was better by 5.5%, mainly on account of better volumes and price. Now I request Sushil to cover the PBIT margin, debt positions, capex, and cash flow.
Thank you. PBIT margins consolidated on a full year basis was at 11.2% compared to 13.5% during the last year. Standalone PBIT margin on a full year basis was at 15.3% compared to 18% last year. Abrasives consolidated PBIT margins on a full year basis decreased from 8.7 to 7%, and standalone abrasives margins were at 16.1% against 17% in FY24. Rhodius reduced their losses, but Awuko PBIT was lower in FY25 due to a one-time gain of 2.2 million euros in FY24 and inventory provisioning of 0.7 million in FY25. Now Electro Minerals. The consolidated PBIT margins of Electro Minerals on a full year basis declined from 15.4% to 11.3% primarily due to VAW. The standalone PBIT margin was at 7.7% compared to 9.5% in FY24. This drop is mainly due to higher input costs and the pricing pressure in the market. Ceramics. The consolidated ceramics margin on a full year basis decreased from 26.5% to 24.7%, and standalone ceramics PBIT margins declined by 28 basis points to 24.8%. Profits from QME Australia and QME America were lower compared to last year. Now the debt position. There was no debt in our standalone books, and total debt at a consolidated basis was at 120 crores at the end of Q4 25 compared to 109 crores at the end of Q3 and rupees 113 crores at the end of Q4 24. The debt to equity ratio was at 0.03 at a consolidated level. In FY25, our capex investment was rupees 282 crores at a consolidated level. Free cash flows on a full year basis at a consolidated level is 22% to PAT compared to 86% last year. The decline in free cash flow was on account of higher working capital and higher capex investments. The return on capital employed on a full year basis at a consolidated level is 14.2% compared to 18.5% during last year. At a standalone level, it is at 16.6% compared to 20.3% in FY24. For consolidated segments, ROCE in FY25 for the abrasives segment decreased from 13.1% to 10%. Ceramics decreased from 46.9 to 35.5%, and the electro minerals decreased from 26.7 to 18%. For standalone business, the ROCE on a full year basis for abrasives has decreased from 44.2 to 36.2. Ceramics has declined from 52.2 to 43.8%, and electro minerals has decreased from 26.2 to 18%. Now about the unallocable expenses. On a full year basis, the unallocable expenses for the standalone were at 63.1 crores in FY25 as compared to 19.8 crores in FY24. This was higher by 43.3 crores primarily due to lower dividend, higher project-related expenses, higher employee costs on account of new headcount additions, ESOPs, and leave benefit valuations. Now I request Mr. Sridharan to talk to you about the future outlook.
Thank you. I will cover now about two things. One is what we look at FY26 given what we have seen. I also would like to share more about the long-term strategy that we have been working for the last 18 months. We expect the full year consolidated sales growth could be 6 to 7% in FY26. Consolidated sales growth in abrasive would be 5% to 6%, majorly driven by growth in standalone abrasives, which could be 6 to 8%, and then Rhodius and Awuko. Sales growth in consolidated ceramics would be 16 to 18%, majorly driven by growth in standalone ceramics and then supported by CUMI Australia and CUMI America. Sales growth in electrominerals could be about 1 to 2% because of the drop in sales in VAW Russia. For VAW, we expect a sales drop to the extent of somewhere between 25 to 30% in FY26. Standalone electrominerals and Foskor to grow in the range of 8 to 10% and 6 to 8% respectively. In FY25, we delivered a PBIT margin of 11.2% at consolidated level. In FY26, this could drop by 100 to 150 basis points because of the softer performance in VAW. Consolidated abrasives margin was about 7% in FY25. We expect this could improve by another 100 to 150 basis points. Consolidated ceramics in FY25 was 24.7%. We expect this could drop by 100 basis to 120 basis points. Consolidated electrominerals in FY25 was 12.5%. We expect this could be dropped by 500 to 600 basis points in FY26. This is again rising from VAW. CapEx could be in the range of about 300 to 350 crores. This is what we are expecting. Just to sum up here, I think we feel that VAW's performance will have a deeper impact in FY26. We feel that the profitability could drop at least by 100 crores, and that is why we have factored in the numbers, whatever I am telling. But it all depends on the recovery. Basically, if the sanctions get lifted sooner than later, what we are looking at, then this could change. And I am expecting whatever I communicated as if the sanctions are continuing. Now, I'd like to share more about the long-term strategy, which is the 5-year program that we are looking at. CUMI has a strong legacy in industrial material and has great starting point to capitalize the growth opportunity available in India and across the globe. Building on our rich legacy, we have spent dedicated effort in detailing out where to play and how to win for all our businesses, creating a clear trajectory of bold long-term strategy for the next 5 years by identifying opportunities in the existing and emerging sectors. Our clear long-term aspiration has been built grounds up with cumulative effort of over 150 leaders across CUMI, its subsidiaries and joint ventures. This will guide our focus and investment for the next 5 years. At the highest level, we want to grow by 2 times in this period with sustained profitability. Our aspirations will be met with the right level of investment to fuel this growth in India as well as globally. This strategy will also be supported with a structured execution roadmap to help us drive on the ground change effectively. We have ensured that our long-term growth strategy is holistic and is anchored on 3 strategic vectors. One is scaling up our core existing businesses, entering relevant adjacencies, and exploring step-outs. Today, I would like to share more details on the first vectors of the group, which is about scaling up our existing business going forward. In abrasives, we build on our strong position to become the leading player in a growing 10,000 plus crores of domestic market, while further scaling our presence in the key export markets. We are reshaping our go-to-market model and investing in frontline capability building. We are investing in digital capability to enhance customer engagement and robust data-driven execution. We have a strong industrial distribution base. Our goal is to deepen the engagement with customers across both retail and the B2B channels through our distribution base. We would gain market share in underpenetrated states and gain customer share to nearly double our domestic market share over the next 5 to 6 years. To drive this growth, we are strengthening our product pipeline across both coated and bonded segment, shaping a dynamic, customer-centric portfolio. This would be through our R&D as well as through an appropriate sourcing strategy. To serve the growing infrastructure and construction industry, we are also investing in expanding our thin wheel capacity using the synergy with Rhodius and Dronco, which is both the asset as well as the technology and asset that we bought. In Electro-Mineral division, we will evolve from a minerals player to a specialty material player. Our focus area would be we will scale up alumina capacity from the current level and increase the share of treated grain. This treated grain means heat-treated grains, silane-treated, sol-gel-treated, blue-heated, and zirconia-coated grains. Thereby, they increase the share of value-added products in the alumina portfolio. We will also focus on export markets. Our current share would almost double in this space. Secondly, we will focus on expanding our zirconia portfolio. We want to add capacity. We also want to add products like alumina zirconia, Zirmol, stabilized zirconia, monoclinic zirconia, and zirconia for thermal spray powders, using the synergy that we will have with Foskor zirconia. And lastly, we will aim to enhance our product development capability to serve the high-growth sectors like semiconductor, aviation, clean energy by venturing into advanced materials such as thermal spray powders, both oxides, that could be aluminum titrate, metallized zirconia, stabilized zirconia, and mullite. Thermal spray powders for solid oxide fuel cells, HPSiC, graphene, silicon nitrate, and aluminum nitrate. These are the newer portfolios that we will add. This strategy will allow us to completely reorient EMD's business strategy. We plan to increase our specialty minerals to 40% share in the next 5 to 6 years. In industrial ceramics, we will scale up leadership in high-margin advanced ceramics while strengthening the core segments like scaling up metallized cylinders, engineered ceramics, wear protection. Growth will be powered by innovations for specialized sectors such as semiconductor, aerospace, defense, and e-mobility. We are expanding into ceramics for semiconductor, wafer fab equipment, opening opportunities across the broader and higher value segment of the value chain. At the same time, we are aligning the long-term global priorities as well as national priorities, entering new areas such as aerospace and defense vehicle and body armor, both alumina, ZTA, RBSiC, and boron carbide, and as well as in electronic sector, which would involve tubes, substrates, brace assemblies. To reinforce this, we are investing in the state-of-the-art manufacturing facilities, strengthening our global footprint, establishing a strategic collaboration with leading technology partners, positioning us for the long-term differentiation. A significant share of our overall investment will be directed towards our effort in expanding industrial ceramics to be a truly global ceramic powerhouse. In super refractories, we will target to be a relevant and scaled player in India's large and growing 15,000 crores plus refractory market. We will continue to push the borders of addressable market by adding newer products in mono and market capabilities and gain share both domestic and export markets. We will use our competence in glass, CPI, carbon black, cement, and addressable global market. We will ensure our focus on cost excellence, considering increased global competition in the domestic market while continuing to grow our overseas footprint. We are also expanding our structural composite capability to advanced composite capability. To support this journey, we are building a future-ready capabilities across key functions. We will scale up our investment in R&D in line with the required growth. We expect to increase our R&D spend 4 to 5 times over the next 5 to 6 years to fuel the innovation across the board. Building a high-performance organization that embodies and demonstrates a set of behavior deeply rooted in the highlights of Murugappa Group, signaling a culture of being even more performance and collaboration-oriented. The highlights of the Murugappa Group are integrity, passion, quality, respect, and responsibility. We also redesigned the role of the functions, various functions, to support the truly global organization. Lastly, we will be comfortable in funding these investments for our growth through our cash flows. To summarize, the entire organization of CUMI is energized by this vision of our long-term growth, and we are supported by a robust governance framework to ensure and track progress. We look forward to providing an update on specific projects as we realize the maturity. So just to sum up, I think for the time being, we are focused on FY26. We have given a broad guideline for you, but at the same time, we are preparing well for the 5-year journey, for which we have broadly given some of the programs and what we are looking at. And just to sum up, the FY25, 2 major issues that we faced is the sanctions in VAW, which had a significant impact. The second one is the reversal of deferred tax credit. These are the 2 extraneous factors. The rest of them are normal business, which we feel that we are getting into. There are issues that we need to focus and address. We feel VAW, as I communicated you, 1 more year, we've kept this at least at a lower volume of 25 to 30%, which brings the profitability also down. That is what we have factored in the guidance that we have shared with you. Thank you, and we will now open up for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Harshit Patel from Equirus Securities. Please go ahead.
Thank you very much for the opportunity, sir. So my first question is on VAW. I missed the sales and profit number that you provided in the ruble terms. Could you please repeat on that, please?
Yeah. I think VAW, on a full year basis, VAW made a sale of 9.4 billion against 9.7 billion, and they delivered a profit after tax, excluding exceptional items, of 119 crores. And you should net off 90 crores of impact on this. So 119 minus 90 would be the profit after tax post this one-time adjustment. If you exclude the one-time adjustment, it is 119 crores against 149 crores of FY24.
Understood. Sure. So on these 4Q margins, which are very weak, and you explained that our volumes were drastically down in the 4th quarter. So is this weak margin performance just because of the operating deleverage due to lower volumes, or are there any other one-offs? So what I'm trying to understand is that were the gross margins intact over there at VAW?
Yeah. So, Arshid, I think this is exclusively coming out of the volume drop. And as I said, it is 25 to 30% volumes are down in Q4. And we have factored in the similar volume drop for the full year next year as well. So that is what I communicated. So it's a pure volume drop.
Understood. So my
And the
second
one-offs
question is...
relating to VAW were earlier communicated in Q3 itself.
Perfect. Understood, sir. So my second question is on ceramics. With the normalization of supplies to a large US-based clean energy customer, we thought that the standalone revenue growth would be in high double digits in the fourth quarter. However, it has not happened so. So was it due to delayed ramp-up at this particular customer, or was there any other reason for the same?
No, I think the ramp-up with the customer is happening as communicated, no challenge at all. Just to give you a perspective, the entire ceramic segment, let's look at it in three broad areas. 65% of the business grew at about 18%. 23% of the business, which is vast ceramics, were flat. And then 12% of the business de-grew at 36%. That is how the overall mix you are seeing about 6 to 7%, right? Now, that camouflages the real growth, what is happening. The 12% is a business which is highly project-driven business, and there are delays in project which really caused this degrowth. So it is nothing to do with the high-margin ceramic business, and whatever we have communicated is very much in line. We feel this project-led growth would come back next year.
Understood. So, what are these 65% and these 23% parts? Could you explain these two?
This consists of engineered ceramics, metallized cylinders. Those are the components, and also the fired refractories. All that put together is the component that consists of 65%.
Okay, and 23% would be the wear ceramics business. Would that be right understanding?
That's what I told.
Perfect, sure. Sir, just lastly, from my side, the standalone EMD margins have contracted sharply, both on YOY and QOQ basis. So could you please explain the reasons for the same? There is also a steep jump in the standalone other expenses. So are these two things related to each other?
No, so I think in the EMD margin, the way I would like to look at it is that we practically passed on the cost increase of alumina to the extent of, say, 85 to 90% cost push. The rest we could not push because of the pricing pressure coming from China. So that is what you are seeing in the margin drop.
Understood. Perfect, sir. That was all from my side. Thank you very much for answering my questions. I'll come back in the questions.
Thank you.
The next question is on the line of Mohit Kumar from ICICI Securities. Please go ahead.
Good morning, sir. So my first question is, how much is the capex and employee expenses you expect to incur to achieve the strategic objectives which you have laid out for the next 5 years?
So thank you, Mohit. We are not sharing this at this stage. The CapEx program I would have loved to share at this stage, but next year CapEx I have shared with you broadly. So that is what at this point. But as I said, we have a clear program to deliver this 2 times top line growth. So we feel that we have enough program to deliver this and should not have an impact. Should not have an issue for us.
And is there a possibility to share the R&D capex which you incurred last year?
Don't have readily. Probably at a later point we will share with you.
Understood, sir. My second question is on the abrasives. How is the competition shaping up? Are you seeing the easing out of the competition? Because you're saying at the same time you guided for in the market share. So how do you think to achieve a higher growth and a higher market share in the next 5 years, given the competition there?
So I broadly described the program that we would increase the market share. Right now, we are looking at the market into 4 broad categories. There is a first category like ourselves and Norton, that's local manufacturing players. The second category is largely, people who either manufacture here or import and then sell in their brand name. These are good brands that they are selling. Then the third category is the non-abrasive companies who import for their own industrial use, right? Direct import from that. And the fourth category is basically the international players which, they import and then sell in their brand. So we feel that we have enough room in these 3 other categories to take a share and that we can grow in the market. And the growth strategy is largely 2 broad strategies. That one is wherever there are product gaps, where we have identified product gaps and that are going to be met both out of the new product to be developed and introduced or sourced where required. And the second one is strengthening the go-to-market. There are certain states where we are not present or we have a very, very low market share where we would like to expand, the market share. Plus the customer, certain, class A and class B customer, we would like to improve our wallet share that we work with them. So based on these 2 broad, and there are sub-elements to this approach, but that's how we are looking at it.
Understood, sir. Thank you and all the best, sir. Thank you.
Just a second. I think my team says that it's about R&D spend. I'll get back to you.
Sure, sir. Thank you, sir. Thank you and all the best, sir. Thank you.
Thank you. The next question is from the line of Amit Anwani from PL Capital. Please go ahead.
Thank you, sir. Thanks for taking my question. My question pertains to your remark about the strategic plan, and you highlighted that we'll be focusing on aerospace, defense vehicles, and I think defense electronics also, and investing in manufacturing facilities and collaborating there. So if possible for you to share more details, what kind of product, any target we have in this space, and will it be high value product, export or domestic market? Any more color on this space?
I would broadly touch upon this. One is it's basically both vehicle and body armor are the 2 space that we would work, because that is where the ceramic has got a play. So that is how we are looking at, and that's why I said that we will be focused on that. It will be based out of either alumina or a ZTA or a reaction bonded silicon carbide or boron carbide. These are the materials that we would be using, and the product outcome would be either a body armor or a vehicle armor.
Sure, sir. So second question again on VAW. So you said FY26 also will be hit by decline of 33% on VAW and impacting the PAT by almost 100 crore for FY26 as well. Wanted to understand how one should look for VAW. Are we in a wait and watch that these things which are dependent on external controls will be better off? Or is there any strategic thinking which has gone into VAW while, devising the 3 to 5 year plan for us?
So I think since the time of the sanction in early January 2025, right? So we are almost a kind of 4-5 months since the sanction has happened. There are a lot of developments which are very positive, right? There is multiple ceasefires has happened between Ukraine and Russia. There are open comments made by both the governments that they would like to end this conflict and then reach a settlement. There is also a lot of facilitation being offered by various countries across the globe. And every other country has expressed that this should end. So we hope, I think, there would be a logical conclusion sooner than later. I'm not an expert on the geopolitical happening, but we positively look forward to that.
Right. So finally, on the Chinese impact, which we have discussed throughout last year also, that there has been a pricing pressure and we tried to devise distribution strategies across segments where it was impacted, including the low-end abrasives and alumina. And we talked about at least 5 to 6 quarters for things to be better off. Are we on the similar notings, or has the things further deteriorated or improved from the Chinese dumping side?
See, again, the time we talked versus the time we are now talking, there are many things that has happened. There's a global trade itself is undergoing a reset. So obviously it is better to wait and watch and how this whole thing would develop. We expect that, the competition from China will continue to be tough, and they will have, upper hand in terms of the bringing down the cost, ability to compete in terms of prices which no one can match. So those issues will continue is what our current thinking is. And obviously we are preparing ourselves to work against that.
Thank you, sir. Thank you for taking my question, and all the best.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, you may press star and 1. The next question is from the line of Mohit Pandey from Macquarie. Please go ahead.
Yeah, good morning, sir, and thank you for the opportunity. Sir, my first question is on the 5-year outline that you shared. So please correct me if I'm wrong, but as I could understand, the bulk of the incremental growth as per your current projections will be from incremental domestic investments. Is that understanding correct?
Right, that's correct.
Okay. And sir, just wanted to hear your thoughts on the turnaround strategy for Awuko and Rhodius, especially in line of the stimulus that is being announced by the economy there on the infra side. Is Awuko and Rhodius likely to have a second order impact there?
So as far as the Rhodius is concerned, as I said and communicated in the call also, they are profitable after you exclude the PPA, which is our own write-off that we are trying to do that, right? So it is profitable and it is the growth trajectory. There's no issue on the Rhodius side. What we are facing is on the Awuko side. We feel that the growth opportunity which you are talking about, the second order benefit that would come, we feel that this would help them. Definitely this is what we are also looking forward to. So there would be a betterment is what we are looking at.
Okay, but for this year's guidance, so clearly it's too short term, so you're not building in any impact because I heard you said risk is largely driven by domestic. Okay, so that's clear, sir. Sir, secondly, on ceramics, if you can please confirm, you said for margins, the guidance is a drop of 100 to 125 basis points. Is that right, sir? If I heard it correctly, or FY26?
Yeah, 100 to 120 basis point, right.
Okay. And sir, what would drive this, please? Yeah. What is it? Because
it is coming from there's a small portion of the business from Russia, so that would get impacted. Hence, we are building that.
Okay, sir. Sir, and across the three businesses, or maybe across abrasives and ceramics, as per your current assessment, over the next 5 years, where is clearly a much higher growth? Would that be ceramics, and what would that mean for overall margin for the company?
So I'm not sharing any margin guidance on the future, but broadly I explained that our overall trajectory, we are looking at doubling it. Second is that, we programs that what would drive the growth is what we have shared. I would like to stick to that.
Sure, sir. Sir, one last question on the minerals to specialty minerals, greater push towards specialty minerals. Sir, if you could please, if it is possible to elaborate what is different this time, because I understand for past several years there has been, an ambition to increase salience of specialty minerals in the overall business. So what's the right to win now, given that, if I understand correctly, we've already been trying this in this area for quite some time?
Absolutely. Great question, and I think thanks for asking. Three different things. One is within alumina, we are increasing the treated grain, and export of alumina is going to go up. That's the first vector which is different. Second is increasing the zirconia portfolio. This is the second vector of difference, because our right to win is very high, because we have established operation in South Africa, plus we are also having a small operation here. So with this, we have, once we increase the portfolio, as I said, it's just not only all varieties of zirconia, whether it's alumina zirconia, zirmol, stabilized zirconia, monoclinic, and zirconia for thermal spray powder. So it's an entire range. That's the second difference. The third difference is focus on thermal spray powders using oxides. That is the third difference, where we have established our capability and we are trying to ramp up with a few anchor customers that we have. The fourth area that we would like to focus, which is on 2-3 different materials. One is the HPSIC and the thermal spray powders for solid oxide fuel cells, and the alumina nitrates, which is both silicon nitride as well as aluminum nitride. The last alone would take about 3-4 years before the real benefit of this would start coming. The first three where we have established the right to grow, and that is how we are planning to grow. These are the difference between the earlier program and this program.
Okay, sir. Okay, sir. Wish you all the best, and yeah, thank you so much.
Thank you. The next question is from the line of Nidhi Shah from ICICI Securities. Please go ahead.
Yes, thanks so much for taking my question. My question is mainly around employee expenses. We're seeing employee expenses have kind of shot up this year, and I understand that some of this bit is from ESOPs. So how much is ESOPs, how much is not, and then what can we expect in FY26 in terms of employee expenses?
So broad guideline is that employee expense as a percentage is still very much under, comparable range only. So there is no change into this. These are minor blips that happens on a year-on-year basis. They're not significant. So since you are making a forecast, I would encourage you to look at it that way.
All right. And could you give out the ESOP number that was for this year in the employee expenses?
Not much, madam. Anyhow, when annual report comes, you will have a lot of details on the ESOP.
Thank you.
Ms. Nidhi, does that answer your question?
Yes, thank you.
Yeah. The next question is from the line of Manish Goyal from ThinkWise Wealth Managers. Please go ahead.
Yeah, thank you so much, sir. Sir, I have two questions. First, on your 5-year plan, so we aim to double sales. So does it include any inorganic initiatives? And if yes, then probably in which areas, or what would be the focus on that? First question. Second question, just would like to know on, have we probably started realizing any cross-leveraging benefits on acquisitions with Rhodius and Awuko? Maybe geography-wise, in terms of leveraging sales and distribution, and also on the product-wise. Thank you so much.
So the numbers that we looked at and shared does not have any acquisition as part of this number. And as far as Rhodius, clearly we have looking at a lot of synergy arising, and in fact we are setting up a could someone typing be slow on that? Yeah. The thin wheel facility that we are setting up will be using the technology of Rhodius, and that would help us to deliver quality products and at a cost that the market would like to have. So this is the synergy, I would say, as an example from Rhodius at this point.
And would it be able to, like the challenges what we face from China in terms of largely on the pricing front, will this probably technology help us to address that? And that is how we are probably looking at it.
Yes. So we have looked at what is the cost, imported cost, and what is also this technology would bring. Plus, we worked on a cost model where we should still be competitive. If we have some dumping happens from China, we should be able to counter that.
Sure, sir. Thank you so much.
Thank you.
Thank you. The next question is from the line of Aditya from Kotak Securities. Please go ahead.
Good afternoon, gentlemen, and thank you for the opportunity. I had a question from my side. The way you have split the ceramics business in terms of components and growth, could you do the same for the abrasives and EMD standalone portions in terms of what is being impacted by China and what is not? It will be good to know the relevance of Chinese competition in terms of revenue share impacted and the real impact being seen given whatever is happening right now in the last 1 year.
So as far as abrasive is concerned, I don't think we have any. I mean, that's a universal, growth that we are having. If you look at, I'm sure you would have looked at other published results in the space. So we both are traveling, give or take about 4% growth. And, so the way I look at it is that almost say 50% plus market is getting imported into India. Of that, 60% comes from China and the rest is coming from other countries. So that constitution, we have not seen any big difference compared to the earlier position. And that's why I felt that there's, you continue to have this challenge and then you are looking at that. So we're countering that. Two things. One is come up with your own new product to be delivered or source for the time being and then develop the product as you become ready to launch this. So we have now looked at a whole lot of sourcing strategy to counter this, and that's the program that we are looking at. As far as the electric mineral is concerned, I think where we are having a challenge is the entire the alumina space is where the challenge that we will have, which is all we talked about so far in the earlier calls also. My guess is that the entire alumina space could be about 30% to 35% of our business. Could be in that range.
Sure. Just to kind of complete this question, so if we only focus on areas between abrasives and ceramics that are not impacted by Chinese, what will be the kind of growth patterns that you are seeing in those kinds of markets on a blended basis?
Yeah, we are not sharing anything like that. I've given a broad next year growth. I've given my expectation in terms of that. So I would like to stick to this, Aditya.
Okay. Okay. The second part on this would be then that, see, the electrominerals segment at a standalone level margins were low. As we see through the next year, how should we think through them? As in, you've been able to pass on 85-90%, and this alumina kind of division is a sizable part of that business. So how to think through whether there is scope of further pushing the pricing up, or should we be assuming low single-digit margins in that portfolio?
So overall, I guided that the EBIT margin on the aluminas will come down by 500 to 600 basis point compared to this year, 12.5%. And I feel that it would take care of some portion of this passing on benefit cost push also. I feel that in the initial Q1, we will continue to have this pressure in India, and then we will slowly start getting this better in Q2 onwards. So that is how I'm looking at it.
And would there be a strategy that we can follow the way we are doing in other areas wherein we'll be in a better positioning in the alumina space from here on? Or is it just dependent on... Yeah. So what's the strategy over there, and how soon can it benefit us here?
Right. I just discussed this strategy is supplying more treated grains in alumina, which help us to have ability to counter this. This is what is our strategy. I listed all the types of treated grains, and we are very much on it. In the next 1 year, we should be able to start launching these products and going in that trajectory.
Noted. Those are my questions. Thank you for responses.
Thank you.
Thank you. The next question is from the line of Bhavan Vitlani from SBI Funds. Please go ahead.
Yep. Good afternoon, Sridharan.
Yes, Bhavan.
Right. So I have three questions. First, if I look at this abrasives business on a standalone basis, where 11 quarters we are seeing low single-digit growth, and there were couple of quarters in the early part of calendar year 2024 where we were seeing some acceleration, but we have now seen deceleration back. So if you could help us understand breaking it into two parts. One is what part is the slowdown in the end market, and I understand abrasives is over-indexed to commercial vehicles, and that segment of the market has slowed down. And second is what we are seeing is acceleration in the thermal power manufacturing, especially when we look at BHEL order book, etc. So if you could help us understand that the underlying market slowdown, and second, what part of the market is impacted by the Chinese competition, and that part we understand has already should have been anniversarized. So that is my first question to understand the standalone abrasives better.
So the industrial distribution is growing at about high single digit, right? And we see that that's a very positive one. Retail is growing at about mid single digit. The challenge is largely in the precision side, where the industrial growth led precision side is where the challenge is. And I think you have pointed out some of the industries, and you have clearly articulated that. So that is where we see this deceleration is happening. So as the industry picks up, we feel that this momentum will start picking up. That's how I read this.
Okay, great. The second question is on Russian piece, and when we see this quarter revenues declined by about 16 odd %, but we've seen a sharp drop in the margins. In this, if you could help, because this is a continuous process industry, so slowing down or stopping of production is difficult. So we would have been forced to sell in Russian market. So what part, if you could just help us understand the kind of pricing pressure that would have happened and the kind of volumes impact that was there in the Russian piece because of forced selling into the home market and exports kind of getting impacted due to the sanctions.
So honestly, there is no forced selling. We feel we are currently not able to sell, hence we are not producing. So hence, as a result of that, the unabsorbed cost, because you carry a lot of cost of this whole manufacturing process, that is what is getting impacted. And as I said, it is not 16%, it is about almost 25 to 30% volume drop in Q4. We expect a similar drop for the next year as well. So there is no, I would say, because of that we are trying to push this into the market, hence the price falls, etc. It's largely we are not able to sell, hence we are not able to produce, hence we are an issue in terms of the profitability.
I understand that. The last question is on the ceramics piece. So if you could just give us where we had seen slowdown last year in some of the specialized piece which was going to we're selling to the hydrogen cells. How has that market now shaping up, given that when we look at your end customer, they are seeing increased order booking? Second is on especially on the metallized piece, where transmission and distribution as a segment world over we are seeing very strong growth. So on that, if you could give us an outlook in terms of what we are seeing in the specialized piece and how and what it does to the growth outlook for the next year in the standalone ceramics piece.
No, great observation. So I think, as I said, that 65% of the ceramics segment has grown about 18%. This includes the sectors that you talked about, and so they are growing, including metallized cylinders, are growing well. So it definitely, you are right in your observation. As I said, the 23% of the business is flat, and hence the average is coming down. That is what I earlier also told.
Sorry. So just a follow-up here. This piece is basically the refractories piece, which is slowing down due to the underlying steel production demand.
No, it's a wear side of the ceramic business, which is what is flat.
Understand that. Yeah, those were my questions. Thank you so much.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today's conference call. I now hand the conference over to Ms. Bhumika Nair for closing comments.
Yes, I would just like to thank all the participants as also the management for giving us an opportunity to host the call. Thank you very much, sir, and appreciate it. Any closing comments from your side?
So, as I said, I think just to give a brief closing comment is that this year there are two extraordinary factors. One is largely driven by Russia sanction, which eventually has got two types of impact. One is a provisioning impact, which we feel that once this sanction gets lifted, reverse back. The other one is the volume drop as a consequence of that, which happened in Q4. The second major challenge that we face is the reversal of the deferred tax credit in AWUKO. So if you take this two factors, which is the substantial portion of the difference that accounted for, we feel that the business is doing fine, and we have spent a good amount of capex this year. We have also spent 18 months of time in creating a good structured, long-term strategy. We've communicated the broad direction in which we are trying to travel. We've also broadly looked at considering the current global trade related issues and the geopolitical issues. We feel that, what we are looking at as the next year, we communicated, we said that we'll have a 6 to 7% growth, and we also broadly communicated the PBIT margin, how it would span out. We feel highly focused on our execution in terms of the long-term strategy, so we will see improvement strength to strength every quarter. Thank you for your support and thank you for your patient hearing.
Thank you. On behalf of DAM Capital, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.